Good morning, students. Hope you're all doing well. Okay, moving forward in our chapter, still continuing with capital and revenue expenditures, chapter number 7. Okay, by now, I hope all of you are clear on what is a capital expenditure and what is a revenue expenditure. Now, moving on, today our topic under discussion is going to be treatment of loan interest. What is loan interest? What is a loan rather? Loan is the money you borrow from a bank or from your father, your friends, anyone. The money borrowed which has to be returned back is a loan, and loan is a liability. Now, if money is borrowed to finance the purchase of a fixed asset, remember the accounting equation? What does it say? Assets equals liabilities plus capital. What does this mean exactly? The accounting equation means that all the assets are coming from two sources of money. Borrowed money, which is your capital, and your liability, and owner's money, which is your capital. Now, if you are borrowing money, it's obviously that you require it for running your business operations. So if you're borrowing money, you're either ways using it to finance your assets. Now, in the example here, let's say you borrow money to finance the purchase of a fixed asset. Now, whenever you borrow money, there is a concept of an interest. You have to pay an interest on the loan you have borrowed. Interest is basically the cost of borrowing money. You know, when you go to a car rental, you get the car and you pay them rent for the car. So what is rent? Rent is basically the cost you have to pay for using the car of another person. In the same manner, interest is the money you are paying because you are using the money of another person. Get the point? Interest. Sorry, let me use the maps. So, I'm saying this. Interest is the money you have to pay as a cost of using someone else's money. Just like you pay exam. Just like you pay for the rent of a rental property. Just like you pay the rent, you have to pay rent for using someone's money. This is known as interest. Now, loan interest, however, is not a cost of acquiring an asset. When you pay the interest, are you actually buying an asset? No, but it is a cost of financing it. So interest that you pay, additional money which you are paying on your borrowed money, because from that money you are buying a car, that additional money is not your capital expenditure. It is your revenue expenditure. Why? Because this additional money is a cost of using an asset. If you remember, when you buy a machinery, it is a capital expenditure because it is an asset. But when you buy the diesel for running that machinery, it is revenue expenditure. In the same manner, when you borrow money to buy a fixed asset, the cost of that fixed asset is your capital expenditure. But when you pay interest on the same borrowed money, that is the cost you are paying for using that loan, using that borrowed money. You are paying extra as a cost. That is your revenue expenditure. Let's take a moment and try to let it see. Moving forth, we will cover the last topic of this chapter, which is capital and revenue receipts. Not expenditure, receipts. Now, please focus here, students. We're talking about receipts now. Capital receipts is When an item of your capital expenditure is sold, the receipt is called the capital receipt. So basically, whatever you are spending on the as a capital expenditure, that means whatever you are buying assets or increasing the value of your assets, on selling them, the money that you get back is called a capital receipt, because this is the receipt you got because of the capital expenditure you had done earlier. For example, selling a motor van that was bought for 20,000. Now when you bought the motor van for 20,000, it was capital expenditure. But now you sold it for 2,000. This is your 2,000 is now your capital receipt. It's now your capital receipt. And what, on the other hand, is a revenue receipt? Revenue receipts are sales or other revenue items such as rent receivable or commissions receivable. Guys, please remember, when you pay the rent, it is revenue expenditure. But when you receive the rent or commissions, it is revenue receipt. Receipt has everything to do with getting money, and expenditure has everything to do with losing money, spending money. So receipts from the sale of goods and services are also known as your revenue receipts. This is clear. So capital expenditure, money spent on buying an asset or increasing value of an asset. Capital receipt, money received by selling an asset. Revenue expenditure, the expenditure you are doing on the day-to-day, the expenditure you are, the expenditure is the money spent on the day-to-day expenses of the business. And revenue receipts is the money you are receiving by the very same. So the money received by selling the goods or services, or the money received as rent. Maybe you're paying rent of a building, but you have an office empty somewhere and you rent it. From there you are receiving revenue. That receiving of rent is your revenue receipt. That concludes our topic for today, and I really hope you guys go over all the videos and the slides ahead in order to get your concepts strong, so that we can move on to solving the questions together. Thank you. Bye.